Welcome back to the Capital Breakdown, where we make sense of money, markets, and investing without the jargon or hype. Today we're diving into a strategy that might sound a little boring at first, dollar cost averaging. But don't let that fool you. This simple habit can really move the needle on your financial future. Imagine if just one tiny consistent action could help you build wealth steadily over time, smoothing out the ups and downs of the market. That's the power of dollar cost averaging. And by the end of this episode, you'll see why it's a favorite tactic for investors who want to stay disciplined and avoid emotional decision-making. So, what exactly is dollar cost averaging? In plain terms, it means investing a fixed amount of money at regular intervals, say monthly or quarterly, regardless of whether the market is up, down, or sideways. Instead of trying to time the market or guess when prices are low, you simply stick to your plan. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Over time, this approach can help smooth out the average price you pay per share. It's like buying snacks on a budget. Sometimes you get a Big Mac on sale, other times a small one at full price, but overall, you end up with a good deal. Why does this matter? Markets are famously unpredictable. Even seasoned pros can't consistently time the market's highs and lows. Dollar cost averaging removes the guesswork and emotional roller coaster, encouraging steady investing through all market conditions. It's a disciplined habit that keeps you investing regardless of fear or excitement. This is especially helpful during volatile or uncertain times, when the temptation to stop investing or sell out can be strong. By sticking to a schedule, you avoid trying to catch the perfect moment, which often leads to missed opportunities or losses. Now, dollar cost averaging works best when paired with a long-term mindset. Time is one of the greatest allies in investing because it allows your money to grow through compounding returns. Think of it like planting a tree. Regular watering and care over years will help it grow tall and strong, even if some days are dry or stormy. Similarly, regularly investing even small amounts can add up to significant growth over decades. Remember, the goal isn't to get rich overnight, but to build a solid foundation for your financial goals, whether that's buying a home, funding education, or preparing for retirement. Another key benefit of this strategy is diversification. By regularly investing in broad market funds, like a broad S&P 500 ETF or a diversified bond fund, you spread your risk across many companies and sectors. This way, you're not relying too heavily on the success or failure of any single stock or industry. Diversification helps reduce risk and smooths returns over time. But keep in mind, investing always involves risk, including the possibility of losing principal. So it's important to understand what you're investing in and not put all your eggs in one basket. Let's talk about how dollar cost averaging can help with emotional investing. Market swings can trigger fear or greed, tempting investors to buy high and sell low, the exact opposite of what you want to do. With a dollar cost averaging plan, your investing becomes automatic, almost like paying a monthly subscription. This removes the emotional element because you're following a set routine. By calmly investing through market ups and downs, you avoid knee-jerk reactions that can hurt your returns. It's a financial habit that builds patience and discipline, which are key traits for successful investing. Now, dollar cost averaging isn't a magic bullet. It doesn't guarantee profits or protect against losses in a declining market. If the market falls steadily for a long time, your investments could lose value. However, it does help manage the risk of investing a large lump sum at the wrong time. For many people, especially those new to investing or with limited funds, spreading out purchases with dollar cost averaging feels less intimidating and more manageable. It's a practical way to build exposure gradually without needing a crystal ball to predict market moves. Here's a quick analogy. Think of dollar cost averaging like building a wall one brick at a time. You could try to build it all at once, which might be overwhelming or risky if your materials aren't perfect. Or you can add bricks steadily, adjusting as you go, and eventually have a sturdy wall. This steady approach reduces pressure and lets you learn and adapt over time. In investing, that steady accumulation can help you build wealth without the stress of timing every move perfectly. So how might you put this into practice? The idea is to set up a regular investment schedule, maybe monthly contributions to a retirement account or investment fund. Many platforms and brokerages allow automatic transfers, which makes it easy to stay consistent. The key is to pick an amount you're comfortable with and stick to it, even when the market feels scary or exciting. Remember, the goal is to build a habit, not chase quick wins. Over time, these small, steady contributions can grow into meaningful assets. It's also important to choose investments that align with your risk tolerance and time horizon. For example, if you're decades away from retirement, you might lean more heavily on stocks or stock funds, which tend to have higher growth potential but more volatility. If you're closer to your goal, you might gradually shift toward more stable investments like bonds or cash equivalents. Dollar cost averaging can work across all these asset types, but understanding your own comfort with risk and your timeline is crucial to making smart choices. Let's not forget that doing your own research and talking to a qualified financial professional are essential steps before making any investment decisions. Every person's financial situation is unique, and what works well for one individual might not fit another's goals or risk tolerance. Capital Breakdown is here to help build your understanding, but personalized advice requires a conversation with a professional who can dig into your specific circumstances. That way, you can create a plan that truly fits your life and ambitions. To wrap up, dollar cost averaging is a straightforward, disciplined strategy that encourages regular investing regardless of market conditions. It's less glamorous than chasing hot stocks, but its power lies in habit and consistency. By smoothing out your average purchase price and reducing emotional decision-making, it helps build a foundation for long-term financial growth. Remember, investing isn't about timing the market. It's about time in the market. Whether you're just starting or looking to steady your approach, dollar cost averaging can be a valuable tool in your financial toolkit. Thanks for tuning in to the Capital Breakdown. Keep building those smart money habits, stay curious, and take control of your financial journey one step at a time. Remember, slow and steady often wins the race. Until next time, keep breaking down those capital concepts and investing in your knowledge. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.